So the Reserve Bank of Australia met again this week and decided to cut interest rates for the second time this year, bringing the official cash rate down to a new record low of 1%. In today's video, I'm going to talk about what this interest rate cut means for your financial situation and look at some ways that you can benefit from this low interest rate environment. Hello guys, Brad here from The Guided Investor, and first of all I want to apologise. I've been absent from social media for a few weeks and I haven't had a chance to post a video. Business has been super busy, which is great. It's the end of financial year and I spent a little bit of time down south. So all in all, I just haven't had a chance to turn the camera on. But it's not all lost because I did get a chance to hang some cool floating shelves that you can see in the background there. So when you get sick of looking at me, you've got something in the background. Okay, let's jump into today's topic. If you didn't already know, the Reserve Bank meets the first Tuesday of every single month to discuss monetary policy. This is where they look at the economy and decide if they should make a change to the official cash rate. If they think that employment is high, inflation is a bit of a risk, and they just want to slow down the economy, then they're going to increase interest rates. If they think that employment is low, inflation is not really a risk, and they want to boost the economy, then they're going to lower interest rates. So this week and last month they decided to reduce interest rates, which means that they're trying to stimulate our economy. So reducing interest rates is going to make it easier and cheaper to get money for business and investing. Now, if you're an accumulator in life, then you're going to praise this reduction because it is a good thing for you. Generally, as an accumulator, you're going to have some debts. You might own your own home with a mortgage against it, and hopefully you'll also have exposure to some long-term growth asset classes like shares or maybe an investment property. When interest rates drop, your mortgage becomes cheaper and generally growth asset classes have a little bit of a boost. And this is because people are looking for alternative investments to put their money into, and they have access to cheaper capital to do so. Now, if you're a pensioner, then an interest rate drop probably isn't a good thing for you. As a pensioner, you shouldn't have any debts, so the interest rate drop isn't going to help you there. And also it's going to mean that you get a lower return on your cash and your term deposits than you were getting before. But I'm guessing most of the people watching this video today are accumulators. If I'm wrong and there's pensioners watching this video and they want to know how to counteract the negative impact interest rates is having on their situation, then leave a comment down below and I'll do a video in the future about this. Now, for you accumulators, let's look at how we can capitalize on this interest rate drop. So the simplest thing for you to do is to keep the interest repayments on your loans exactly the same. By doing this and the interest rate drops, it's going to mean that more money for every repayment is going to go towards paying off the capital of the loan and less is going to go towards interest, which is going to have the loan paid out a lot quicker. You can also look to increase repayment on your loans, which is a great thing to do in any interest rate environment, and it's really going to help boost your net asset position. Now, just because the cash rate has dropped doesn't mean the interest rate on your loan is going to reduce. Firstly, you need to make sure that you have a variable loan, and secondly, you need to hope that the lender you're with passes on the rate drop. The next way to benefit in a low interest rate environment is to invest. Now, for every extra dollar that you have spare, you need to weigh up the pros and cons of using it to pay down debt versus investing. While interest rates are so low, the return you get from paying down your debts is quite low, and this is simply because the return on your money is equal to the interest rate on that loan. So for example, if the interest rate on your home loan is 3.5%, then for every dollar that you put into your home loan, you're essentially getting a tax-free return of 3.5% on your money. Comprende? Obviously, if you have car loans, personal loans, credit cards, or really any debt that isn't secured against a property, then you should look to get rid of that first before investing. These debts generally have very high interest rates and really do hinder your situation. However, if the only debt is the mortgage against your house, then it's good to sit down and have a look at the benefits of investing your money elsewhere. So when it comes to investing, you want to find an investment that's going to generate a higher after-tax return than the interest rate on your mortgage. If you can do this, it's going to put you ahead. And you can simply invest using your spare cash flow, or you can look to boost your investment with borrowings. When you borrow to invest, it's called leveraging. And leveraging basically magnifies the outcome of that investment. So if the investment goes up, then leveraging is going to amplify your returns. If the investment goes down, then leveraging is going to amplify your losses. There is also potential tax benefits of borrowing to invest, as the interest that you pay on the associated loan is generally tax deductible. If you decide to go down the investing route, then here are a few things to consider. Before you make an investment, make sure that you structure your investment correctly so you don't lose a lot of return to tax. Only invest in things which you understand. Try to keep your investments diversified. If it sounds too good to be true, then it probably is. Obviously, if you're not very comfortable with investing or you don't understand investments very well, but you like the idea of it, then I would suggest you speak with a financial advisor. They can outline all of the different investment options available to you and consider the pros and cons of each investment opportunity and let you make an informed decision. But whether or not you decide to use this low interest rate environment to further reduce your debts or start investing, there is no right or wrong in this situation. Each option has its own pros and cons, and at the end of the day, you just need to feel comfortable with what you want to do. Guys, I hope you found this video helpful. If you did, please give it a thumbs up. I'll try not to leave it so long before doing my next video, and if you haven't already, make sure you subscribe so you don't miss the future content.